The operating section. We have two ways of preparing the operating section. We have the direct method and we have the indirect method. The direct method takes each item on the income statement and converts it to the amount of cash that came in or went out. For example, on the income statement I show sales, don't I? Does cash come into me from making sales? Well, it does. I'm going to show salary expense on the income statement. Did cash go out related to salary expense? Yeah, I got to pay my employees. I'm going to show rent expense on the income statement. Did cash go out for that expense? Well, yeah, I got to pay my landlord. So most every item, not quite all, but most items that show up on the income statement have a direct cash comparable number where we calculate how much cash came in and went out for that item. That's what the direct method does. The direct method is the easiest to understand, but is the most complicated to prepare. The indirect method starts with net income, adds some things and subtracts some things to get to cash from operating activities. The focus here is on explaining why net income and cash flows from operating activities are different. We're going to reconcile those two here. It's the hardest to understand for most people, but it is the easiest to prepare. The only difference between direct and indirect is in the operating section. Investing and financing will be exactly the same. Your bottom line total for the operating section will be the same if you do it direct or indirect. The bottom line total is going to be just the same. However, the way you go about it is entirely different. This was not on your handout. Let's look at that. First off, direct method. Let's just read this and see if we understand it. Cash received from customers. Do you get that? Does that make sense to you? That's a positive number, cash comes in. Cash received from interest. Does that make sense? Positive number, cash comes in. Cash paid for inventory. Do you get what that means? Negative number means what? Cash is going out. Cash paid for salaries. Does that make sense? Negative number, cash is going out. So overall, we have a positive 2,900, which means that more cash has come in than gone out in total. But does that make sense to you? And you got to realize y'all know far, far more about accounting than 99% of the world, because you've had almost one class in it, okay? Most of the world hasn't. But that makes pretty good sense. Here's the indirect method. Operating section. Net income. Okay, we get net income, right? We're going to add an increase in accounts payable, and we're going to add a decrease in accounts receivable. I'm going to subtract an increase in supplies, and I'm going to subtract a decrease in wages payable. Still come up with 2,900. Do you understand that one? I don't think it makes a whole lot of sense either. I do, and I can explain it, but not in a way that average consumer who knows no accounting can actually grasp, I don't think. Now, you know more accounting than the rest of the world. You understand the first one pretty good. Do you understand that next one? Once I added an increase, once I added a decrease. Once I subtracted an increase, once I subtracted a decrease. What's going on there? Okay, which one makes more sense to you? Direct. I'm going to teach you how to prepare the indirect. You say, well, why in the world is that? There really is a reason for it. FASB. Remember FASB, the Financial Accounting Standards Board? They set the rules for GAAP. How we go about doing accounting. FASB encourages companies to use the direct method, permits them to use the indirect method. But there's a catch. Here's the catch. If you do the direct method, you also have to do the indirect method. So here are your options. If you do the direct method, you've got to do the indirect method. So you can either do the direct and the indirect, or if you do the indirect, that's all you do. So do you want to do direct and indirect, or do you just want to do indirect? What does everybody do? Just the indirect. I already told you the direct one's the most complicated to prepare. Why prepare it when you don't have to, in effect? You're going to have to do indirect either way you do it. So what does everybody do? Indirect. Which unfortunately is the one that when stockholders look at it, they're going to say, what in the world is that? But that's all right. That's why we're going to do the indirect. And the good news about the indirect is it is the simpler of the two to prepare. So from a student standpoint, it's a very good thing that FASB does it that way. Let's talk about doing the operating section using the indirect method then. The format of the operating section with the indirect method says we start off with net income, and then we will add and subtract adjustments. So net income, plus or minus some things, is my cash flows from operating activities. It's those things in the middle, those adjustments that we're going to spend our time talking about. But this is going to show why there is a difference between my net income and my cash from operating activities. We have two types of items we're going to add or subtract. Again, here's McDonald's. I want you to look at this first one. They call it charges and credits. And the second one says changes in working capital items. Now, working capital, we did discuss that previously. Do you remember? Current assets minus current liabilities is my working capital. So here we're talking about changes in my current assets and my current liabilities. So they have two groups right there is what I want you to see. I don't really care what you call them. I call them type 1 and type 2. I don't know. I can't get a very creative name for them. Type 1 are my changes in current assets and current liabilities. In other words, my changes in working capital, which we just saw McDonald's do. Current assets. Current assets are assets that I expect to use up or convert to cash within what time period? Short term, within 1 year. My silly word for current assets is crisp, cash, receivables, inventory, supplies, and prepaid. Current liabilities are debts that I plan to pay off within 1 year. Tell me some common current liabilities, like accounts payable that I owe to my vendors. I better pay those off within a year, right? Wages payable, I better pay my employees what I owe them within a year. Taxes payable, perhaps. All right, so short term. So crisp will give you your current assets and then your short-term liabilities. I'm going to try to explain to you why we do it this way, why I add this and why I subtract this, and then I'm going to come up with the simplest way that I can to help you remember it. Okay, I want you to understand the logic first, and then we'll get to the practicality of preparing it. We're going to add a decrease in my current asset. For example, what if accounts receivable during the year decreased? It went down. What would cause my accounts receivable during the year to go down? What must have happened? They paid me. They paid me. What caused the balance in accounts receivable to go down? Well, when customers pay me, cash is going to come in. When cash comes in, we're going to add. How about merchandise inventory? What if it decreased during the year? What must have happened? I sold it. When I sell my inventory, what happens to cash? Cash comes in. I'm going to add it. Good. We're going to add an increase in a current liability. For example, accounts payable. If accounts payable went up, in effect, we borrowed more money. We have borrowed more money. When you borrow money, cash comes in, we're going to add it. What do we subtract? An increase in a current asset. What if merchandise inventory went up during the year? What must have happened? I bought more. When I bought more inventory, what happens to cash? Cash goes out, I'm going to subtract it. How about if supplies went up during the year? What must have happened? I bought more. When I buy more, what happens to cash? It goes out, I'm going to subtract. Finally, I'm going to subtract a decrease in the current liability. What if accounts payable went down during the year? What must have happened? I paid it off. When I pay off my debt, what happens to my cash? It goes out. So when cash comes in, I'm going to add it. When cash goes out, I'm going to subtract it. That's the logic. Now, I have tried teaching this lots of different ways before. I used to have a silly sentence that was just this long. I have now boiled it down to what I think is the simplest way to do this. Don't you always expect to add an increase and subtract a decrease? Isn't that logical? To add an increase and subtract a decrease. Current liabilities work just the way you expect. Add an increase and subtract a decrease. Current liabilities work just the way you expect. Add an increase, subtract a decrease. Current assets, on the other hand, work just the opposite of what you expect. You subtract an increase and you add a decrease. So that is the simplest way I can give it to you to help you remember. Current liabilities do what you expect. Add an increase, subtract a decrease. Current assets do just the opposite. We add a decrease, we subtract an increase. There are a few current assets or current liabilities we're going to ignore. Dividends payable. We're going to ignore that account right now because the dividends payable account relates to paying dividends. Paying dividends goes in my financing section, not operating. We're also going to ignore any changes in notes payable. Notes payable relates to borrowing money. Borrowing money is money coming in from my creditors or paying it off. That goes in the financing section also. Investments in marketable securities is if I buy stocks or bonds in another company. The investments in marketable securities will go in my investing section. Doesn't that make sense? Investments, investing, we'll ignore it in the operating section. Finally, we're going to ignore any change in cash at this point. Now, if you like doing a jigsaw puzzle, you know, the best part about a puzzle is when you get to the very end and you have one piece in your hand and it fits that one piece of the puzzle that it takes to make it complete. The change in cash is going to be used. We just aren't going to use it in the operating section. Instead, when we finish our whole statement, we add up operating, investing, and financing. Let's suppose I had a $100 inflow from all three of those. A grand total of $300 inflow. During the period, I should see cash change by that exact same amount. So in other words, it's my check figure. Remember back in LIFO and FIFO, We had a check figure. If we added cost of goods sold and cost of ending inventory, it came up to a check figure. Same thing here. Cash then becomes my check figure. The second type of items we're going to talk about are items that affect net income but don't provide or require cash from operating activities. Remember, the starting point in the operating section is net income. We're trying to get down to cash. If something affects net income but not cash, we need to back it out. We're going to add items that make my net income go down but don't require that cash be paid out. These would include depreciation expense. That reduces my net income, but do I pay out any cash for depreciation? No. Remember we said earlier it's our non-cash expense? Amortization expense is another non-cash expense. Now we mentioned this briefly in Chapter 9. We depreciate items like building, furniture, equipment, and machinery. We amortize intangible assets. That's things like patents and franchise and copyright and goodwill. We did not cover that in Chapter 9. The only thing I said you were responsible for is knowing that we amortize those. So in your mind, I want you to think of amortization expense being really the same as depreciation expense. It's just on a different type of asset. So conceptually, amortization expense and depreciation expense are the same thing, just on a different group of assets. There's one other little difference in terms of how they're accounted for. Let me just mention it briefly here. To record depreciation, we debit depreciation expense and we credit what? Accumulated depreciation. Very good. Which is what type of an account? Contra asset. So you would think if I am amortizing an intangible asset, I would debit amortization expense and credit accumulated amortization, you might think, but we don't do it that way. Instead, the credit goes directly to the asset account. That makes it a little bit different, and that'll only pop up in like one of our homework problems, but we actually credit the asset account directly. Loss on sale of assets. Losses make my net income go down. If I sell an asset at a loss, does that require that cash go out? Well, no, quite the contrary, because if I sell an asset, cash is going to come in. So therefore, we subtracted it to get to net income. We're having to cancel it out. So all these items, we're going to treat them the opposite as what we did on the income statement. We subtracted them on the income statement. On cash flows, we're trying to cancel them out, and we do so by adding them back in. We only have one item that falls in the other group of things that we're going to subtract. It's something that makes net income go up but doesn't provide cash from operating activities, and that would be my gain and sale of assets. Remember, gain and sale is when I sell an asset for more than its book value. When I sell an asset at a gain, does cash come in? Well, yes, it does, but the cash that comes in from selling that asset goes in what section? Operating, investing, or financing? It goes in investing, not in the operating section. So it made my net income go up, but it didn't provide any cash from operating activities. Therefore, we have to subtract it. Again, gains are added on the income statement. They'll be subtracted on the statement of cash flows. I have a silly sentence. Skinny girls are dancing at luau's. SG says we're going to subtract gains. A says we're going to add depreciation expense, amortization expense, and losses. Now, sometimes when I give you a silly sentence, I'm like, you might use it, you might not. I would use this one, quite honestly. I think it's going to help. So we have two groups. I'll call this my skinny girls group. I call it all the time. Even though those are bears and penguins dancing, you get the point here. I'll call it the skinny girls group. Those are the items that affect net income but don't affect cash from operating activities. And the other group is my change in current assets and current liabilities. So again, these items in the skinny girls group, they're going to be handled the opposite of what we did on the income statement. If they were subtracted on the income statement, they're going to be added on this cash flows. If they were added on the income statement, they're going to be subtracted here on cash flows. Here's McDonald's. Let's just kind of look at it again, see if it makes a little bit more sense. This is just the operating section. Depreciation and amortization, do you see where they added those back? They made net income go down, so we're canceling them out. We have to add it back because they were subtracted. Gain on sale. Notice gain on sale. What did they do? We had that for 2 years. We subtracted. It made these numbers right here be bigger to begin with. We are then going to subtract it to cancel it out. And here are my changes in my current assets and current liabilities. Now, what I want you to notice is this year they added it, this year they subtracted, and this year they subtracted. Why the difference? Well, 1 year the item must have gone down, hence we add it. The other 2 years it must have gone up, and we subtract it. So you see, we might be subtracting, adding. It depends upon whether that account has gone down or gone up. We're going to do our first example. I'm going to teach you statement of cash flows, a little piece at a time. Okay, we're going to learn the little piece, so that at the end we're putting them all together. But it's overwhelming at first to jump into the whole thing, so a little bit at a time. Net income's $93,000. Depreciation expense is $13,000. We have a $2,000 gain on sale. For right now, I'm just telling you what you need to know. I'm not putting any extraneous material in there. And then I tell you the change in some balance sheet accounts. Accounts receivable, merchandise inventory, accounts payable, and salaries payable. And we want to prepare the operating section. First thing, depreciation expense. That goes back to my skinny girls. Skinny girls are dancing at luau's. Means what? Subtract gains, add depreciation expense, amortization expense, and losses. So what are we going to do with depreciation expense? We're going to add it. It made my net income go down, but didn't require that cash go out. I'm canceling it out. There's a place in your handout for you to write this. We're going to add. It made my net income go down, but not require that cash be paid out. Gain on sale. Skinny girls, subtract gains. So we're going to subtract that. Why? Because it made my net income go up. It did provide me with cash, but not cash from operating activities. The cash that it provided me is going to go in the investing section, not operating. Now let's move on to the changes in current assets and current liabilities. Now, if I were you, I would write this down. I just think it's a lot easier if you just write this down, so then we don't have to think quite so much. We can just look at what we wrote down. The way we were going to approach that, we said, the changes in current liabilities. Current liabilities work the way that we expect or not the way we expect. Current liability, the way we expect. And we expect to do what? Add an increase and subtract a decrease, right? So I would, somewhere on the side of my paper, write a current liability increase. What are we going to do with that? We're going to add, because current liabilities work the way that we expect. A current liability decrease. Again, current liabilities work the way we expect. What do we expect to do with a decrease? Subtract it. Current asset increase. What do current assets work? The way we expect or the opposite? They work the opposite. We expect to add an increase, so instead we're going to have to do what to it? Subtract, right? The opposite of what we expect. And finally, current asset decrease. Right? Current assets do the opposite of what we expect. If we have a decrease, we expect to subtract it, but now current assets, we're going to add it. And if I were you, I'd write that down in my paper. So then when I approach them, I don't have to think too much. I can look at what I wrote down. I just think it's a lot easier there. So let's start off with that. Accounts receivable began at 5 and ended at 22. During the year, what happened to accounts receivable? Did it increase or decrease? It increased by $17,000. There's a place in your handout to write this. What type of an account is accounts receivable? An asset. Specifically, it is a current asset. So we have a current asset that has increased. Third one down. Current asset increases. What are we going to do with that? We're going to subtract. If you think about it, if accounts receivable went up, in effect, we've loaned somebody some money. That makes my receivable go up. When we loan somebody some money, cash is going to go out. We're going to subtract. Merchandise inventory began at 8, ended at 3. During the year, what happened to merchandise inventory? It decreased. What type of an account is merchandise inventory? It's a current asset. Now, so we have a current asset that's decreased. Let's look at what we wrote down. What do we do when we have a current asset that decreases? We're going to add it. Why do we add it? Well, if inventory has gone down, I must have done what? Sold it. If I sell my inventory, what happens to cash? Cash comes in, and I'm going to add it. Accounts payable began at 9, ended at 15. During the year, what happened to accounts payable? It went up. Accounts payable is what type? Current liability. And it increased. Well, let's see. What do we write down? If a current liability increases, what are we going to do? We're going to add. For a current liability to go up, for accounts payable to go up, in effect, I borrowed more money, didn't I? If I borrow more money, cash is going to come in, which is why I'm going to add it. Finally, salaries payable began at 18, ended at 7. During the year, salaries payable has gone down. What type of an account is salaries payable? Current liability, and it's go down. Let's see, the rules say current liability decrease. What are we going to do with that? We're going to subtract. Why is that? Well, for salaries payable to go down, for a liability to go down, I must have done what? Paid it off. If I pay it off, cash is going to go out. That's why I subtract. Let's prepare the operating section then, given that data. Again, all I did in this first example was to pull out just what you needed. We start off with net income of $93,000, and then we're going to list my adjustments. The first one I'll show is my depreciation. We're going to add that, and then I'm going to subtract my gain on sale. I'm going to add depreciation expense, and I'm going to subtract gain on sale of land. Then I'm going to come up to my next 4 items, the changes in my current assets and current liabilities. Now, the only thing which is a little bit different here is by each of these items, I want you to write whether that account has increased or decreased during the year. So, for example, accounts receivable has increased. If you would write the words increase in accounts receivable, and since we are subtracting that, we're going to put parentheses around everything that we're going to subtract. What was the next item that we had after accounts receivable? Merchandise inventory, I believe. Did it increase or decrease? It decreased, and we said that we were going to add that then. Then we move on to my accounts payable. During the period my accounts payable had increased, we're going to add that. And then finally we ended up with my salaries payable, a decrease, and I was to subtract that. So those are my adjustments. First off, we have the skinny girl items, and then we have the changes in current assets and current liabilities. Now we finish it up. We take the 93 plus 13 minus 2 minus 17 plus 5 plus 6 minus 11, and we end up with $87,000. That's a positive number. That tells me that from my day-to-day doing business, normal operating activities, $87,000 more cash came in than went out. Would you like for that number to be a positive number or a negative number? Positive. Big or small? Big. We'd prefer to have a lot more cash coming in than goes out.